All right. Hello, everybody. This is Tom Randall again from GoldenCare. I want to welcome you to the webinar today. And we're really excited today to have NGL's National Guardian Life's Lawrence Vivenzio on. And before I jump in and introduce Lawrence officially, I do want to say hello from GoldenCare. I'm the National Marketing Director here, and we've got our sister companies, all part of the Integrity family of companies, and really proud to be part of that company. And we really kind of represent the long-term care side of it with Integrity, with all the different partners out there. And that's us at GoldenCare. AIM, our sister company we worked with for years and years and years out in Yakima, Washington. Mike Anderson, unfortunately, was held up, so he wasn't able to jump on the call today. But we're really happy to have Katie Novotny here from Premier. Premier, she heads up the long-term care and the short-term care side of it over at Premier. And it's been really fun to get to know her a little bit and to work more closely with her as part of this Integrity long-term care family. So Katie, if you're on, you can jump on and say hi to your folks out there for sure.
Well, thanks, Tom. Hi, everyone. Thank you so much for joining us. And I, too, am extremely excited about having an Integrity long-term care call out there and to also have share some information on his worksite.
You bet. Thanks, Katie. Thanks, Katie. And you know what? I'm not going to take away a lot of the steam. Lawrence, I've had a pleasure to know him for quite a few years now. Lawrence is one of those guys who really understands this business. He certainly understands NGL, and hopefully he's going to treat you to a lot of great information today. He spent his entire professional career right out of college in really kind of dedicated to long-term care. And like so many of us out there today, Lawrence, I think, had a personal story that his grandmother, I believe, if I remember right, had Alzheimer's, and she suffered with Alzheimer's for quite a few years. And that was a big part of why he really has it in his blood, like a lot of us who do this for a living in a long-term care arena. And I knew him back when he worked with Phil Shelton and now with NGL. And again, it's been my pleasure to know him. And I'm not going to steal any more of his thunder. I'm going to turn it over to Lawrence and let him entertain you and educate you today about what NGL can do for you and your clients out there. So Lawrence, thank you so much for coming today. I'll turn it over.
Yeah, well, thanks for that introduction, Tom. I appreciate it. And you know what, I'll tell you, I'm impressed because I think I told you that story the better part of, I don't know, 7 or 8 years ago. So good memory. Good afternoon, everyone. This is Lawrence Vivenzio, for those of you who don't know my voice just yet, and really appreciate the time here you're taking to learn a little bit more about what NGL has to offer in the worksite arena. For those of you who aren't too terribly familiar with NGL, just going to do a little bit of company background. We have an excellent, which is A- rating from AM Best. In fact, Best just upgraded our outlook from stable to positive. And in the past, when I've seen that happen to other companies, they're generally soon going to have a rating upgrade. So very soon, we might even be better than the A- excellent. So stay tuned there. We're doing all we can to try and improve and have solid offering for you. And if you don't know much about NGL's history, it was founded in 1909, formed in 1910. This company has been around for a very long time. I think we just got our financials back. Assets are now in excess of, I think, $4.7 billion. So you have a solid company, been around for a long time, well-rated, good financial backing. And we partnered with an expert TPA who administers our long-term care product, EssentialLTC. And they've been doing nothing but long-term care for over 30 years. And they administer well over 200,000 insurance policies today. So we relied on them to use some of their experience and their expertise in creating this product called EssentialLTC. And when this product was being designed, we really wanted not only a price competitive product, but a product that could flex and mold and fit into a lot of situations. How do we do that? You get the right folks behind it to price it, underwrite it appropriately, and create a clean pool of risk there, not only for the insurance carrier, but for the insured's policyholders. So I think we're doing something right now that the product's been on the street for about 4 years. We still don't have a claim. So this thing's been coming out exactly the way that we thought information would go into the funnel. It's coming out the other end exactly how it should. So thus far, you've got a pretty stable product with some pretty interesting features. And I'm going to talk about those features and how they relate to the worksite conversation as well. For those of you that may not know much about where we're available just about everywhere. The light blue states are partnership approved. The dark blue states, we are not partnership. In fact, the only two states that are dark blue that are partnership are Connecticut and Indiana, two of the originals. We are working on filings for Montana. New York we're having discussions about. And California, here I'll leak this a little bit, we're hoping to have late this quarter or early next quarter. California is coming very soon. So fireworks, champagne bottles, that's all I can see in my head because we filed over 4 years ago, I think. So California's on its way. Now, as to kind of the crux of the product, when I mentioned earlier, we really wanted to create a product that can flex and mold itself to a lot of different situations you're going to hear from the consumers out there. And how we do it is with some of the key features you see in that gray box on the screen. We issue a joint policy. We have unique shared benefits. You have 2 through 6 year benefit periods or lifetime benefit period. You can have a single pay long-term care, and you can get a benefit if you never need care via a return of premium rider. So I just wanted to quickly go through some of these key features because this is all going to relate into how you structure these plans in the worksite. So when you look at the kind of traditional setup, where do we really stand out from our competition? Well, we issue one policy to a couple. We're very compelling for couples. It is a joint policy, and each of those blue bubbles there, they each have their own separate benefit pool. Now, if you get the shared benefit amount rider with that, there is a third separate shared pool of money available to either or both of them if they exhaust their own initial pool of benefits. So joint policy, joint premium, separate benefit pools, and if you get shared, it's a third benefit pool. Where does this play really well? Well, let's say you were selling a 5-year benefit period. If you did this setup, you've actually got 3 5-year pools of money. Now think about that. 15 years worth of care, that's a whole lot of care for a couple, right? Pretty compelling argument, and it's price competitive. Some other key features, we do have a lifetime benefit period in addition to the 2 through 6 year benefit period options. I know that can be pretty interesting, but again, if you use that joint shared kind of a model, 3 5-year pools, that's a lot of care for a couple. So personally, I quote that more frequently than I quote lifetime for folks who think they might need an extended period of time while they're receiving benefits. We also have, in addition to lifetime premium payment like everybody else, we have a 10-year premium payment option. Policy can be fully paid up in 10 years. We also have a single premium payment option. Day one, the policy is fully paid up, non-cancelable, not subject to rate increases. You have a guaranteed premium on a traditional long-term care chassis. Pretty interesting. Now at the 10 pay, once it's paid up in the 10-year premium payment duration, it is paid up, non-can, not subject to rate increases. So pretty interesting things on a traditional chassis. We also have return of premium and surrender options. So you can have a benefit at death or a surrender value. Now when I talk about a few of these things, this sounds a whole lot like asset-based product, doesn't it? But it's a traditional chassis, but it tells the same story, which is if you need care, there could be a long-term care benefit. If you don't need care, we can give this return of your premium to your beneficiaries. Or if you decide you change your mind and you want to cancel the policy, there's a surrender value. So it tells that same story of whether you live, you die, or you decide you want to cancel, there could potentially be a benefit. All on this product called EssentialLTC. How do we do it? Well, we have 2 return of premium riders. The first one is called limited return of premium. With that, we look at the premium, we look at any benefits received as claim payments. If there's anything left, it goes to the beneficiary. Of course, if there is a claim much larger than premiums paid in, the beneficiary gets nothing. So what does this look and feel like? Well, a whole lot like an asset-based product, right? Instead of a premium pool of money, you have a death benefit pool of money that is reduced every dollar based on long-term care claims. If there's anything left, it goes to a beneficiary, right? I guess some of them have residual death benefits, but many don't. And this tells the same story on a traditional chassis, which is very compelling in the worksite, and I'll get there in a minute, because it can be tax deductible. Life insurance is not tax deductible. Now we also have another return of premium rider we call full return of premium. With this one, we look at the premium, and instead of reducing benefits paid, we just say, regardless of that, every penny you paid in will go to your beneficiary when you die. The full, of course, is more expensive, but tells a very interesting story. When that shoe fits, it fits very, very well. So it's not used as frequently as the limited, but when you think about that, there's no policy based in life insurance that works the way the full return of premium does. You can't use all of your death benefit in long-term care and still get every penny of premium back when you die. It's a pretty interesting scenario. Now, both of these on a joint policy are second to die return of premium benefits, so be aware of that as well. Now, we can take either of those and add a surrender value. Most people, I think, are concerned about, what if I live and need care? What if I die and don't need care? Most people aren't so concerned, as many of you know, because next to nobody lapses their long-term care. Most of them aren't so concerned about, what if I change my mind and cancel my policy? So we didn't build it in automatically. It's an extra rider, and if you don't want to pay for the surrender value, you don't have to. Whereas with asset-based products, that stuff's all built in. So another pretty compelling way to have that flexibility to really mold and flex this thing and meet the needs of the client. If they don't want to pay for a surrender value, they don't have to. And as you see on the screen, it will grade up to 80% of premiums paid by year 4, and it'll stay there for the rest of the life of the policy. All on a traditional chassis. Pretty interesting. So I talk about the key features in the asset-based so we can see how all of this is going to apply to the worksite and conversations when you're talking to business owners or employers, meaning HR folks or board members, etc. So here's what we did with the product. We designed something to be pretty flexible and fit very well in the small business market. Because small businesses, say a 10-employee business, they really don't have many options out there. And at the time we designed this particular thing, there weren't any options out there for those kinds of groups. So what we did is we created something called the Employer Group Rate Class. Notice I called it a rate class. So it's not a discount, there's not any kind of separate product, it's just another rate class on the existing product. And that rate class provides unisex premium rates. Okay, so if you have, let's say, a 50-year-old male, plan costs him $100. 50-year-old female, plan costs her $100. If you have a 50-year-old joint policy, the plan will cost the couple altogether $100. So it's one rate class, unisex pricing. If the employee is if the spouse is the same age or younger than the employee, it's basically a buy one, get one free situation. It makes no sense not to get spouses involved here. So that pricing, that unisex pricing, is very compelling for couples. Our issue ages are the same, 40 to 79, including joint applicants. So if you have a 35-year-old and 52-year-old couple, that couple would get a 52-year-old joint premium rate. But since that joint applicant's not 40, they are not eligible for the joint. So I do know that's one limitation we have sometimes with executive carve-outs. If, say, there's an executive in their 30s, it doesn't quite work out for that particular person. But there could be an alternative solution there if we're a great fit for the rest of that group. So keep our issue ages in mind. Now, as for processing, we generally approve groups same day. So if you send us a group approval form, you'll hear back from us the same day or the next day. We'll approve just about any business with at least 5 employees. As long as you're not sending me a group approval form for a company called Bomb Testers LLC, we're probably going to approve your group and not have too many questions. We're not going to hit you with census analysis paralysis and tell you, what percentage of employees and huge minimum participations. None of that. In fact, we're not even going to ask you for a census unless you expect more than 10 employees to participate. Okay? So low minimum group size, we'll look at just about any business with 5 employees, and low minimum participation. Varying by state, it's only between 2 and 5 issued employees. Many of those states are at 2. Okay? There are a small handful that are 5. And that's it. So, you've got, say, these closely, oh, by the way, and there's no compensation reduction. You see that on the last bullet. You use the employer group rate class, regular comp level as if you were selling an individual policy. So you've got a pretty interesting scenario here where you can present an option now to these small groups, these closely held businesses, doctors, lawyers, or not to be too facetious, insurance agencies, right, where there might be 5 to 10, maybe 20 employees, and the business owner's interested, and now he can, and his business partner, for example, that's 2 issued employees, in many of the states that can work, can get themselves a policy. Or if they want to do a carve out, we're a great fit for executive carve outs of up to, say, maybe 50 or 100 executives. Of course, we can accept larger groups, but many of them are looking for underwriting concessions, and that's just not where we fit. The way we're able to do all these things and keep this flexible and keep all the options available and not limit benefits is because we're going to underwrite the individual. So why not make a group process that's easy to set up, low minimums, and pay the full comp, and have an option out there for these small groups? So that was the idea of why we designed this and where we think it's going to fit really well. Now these mid-sized groups, there's still a lot of them, say 50 employees. That group, and it's voluntary, that group might be too small for many carriers out there. You know, if they're not going to meet a high minimum participation, we could be a great fit, especially if it's a state where only 2 or 3 is the minimum issued employee requirement. I see a lot of opportunity, and when I was in the field, Tom mentioned some of my time in the field, we had a lot of groups coming to us who said, hey, we've got this old, let's say, Unum plan, and now we want to offer a new option to the employees. We can do that. We're happy to take those groups. Or groups who want really comprehensive options they can't find elsewhere. Say they want to do an executive carve-out and they want it to be a 10-pay. We're a great fit for that group. You can do single pays on the worksite. You can add these return of premium or surrender options. And as we just went through earlier, there's many more really appealing features about this product, and they're all available with the employer group rate class. So, you know, a couple strategies, you know, for those of you who have done this, this might be a little obvious, but for those of you who haven't, you know, you run into some common things. The first pushback when you're trying to get some employer money on the table is, I'm worried about, you know, cost, and I want to make sure everyone can get something. Well, you can use this Essential LTC product, and why don't you just fund a base plan? If your employees want to buy up, they can. This product has all these wonderful features that they can choose from, and you can fund that base plan or a base premium amount, and we can create very customized, well-molded products for each of your different employee situations. Now, a biggie, many of them don't know that they could deduct it. If they're worried about what it's going to cost them, oh, by the way, Mr. Johnson, your business is a C Corp. You know, you can deduct anything you buy on yourself or any of your employees, and that includes your spouse and any of their spouses. So that could be a pretty interesting result there where they say, well, I'm not so worried about cost anymore if we get a great write-off from this. Now, there are some other tax situations where, say, it's not as flexible as it is in a C Corp scenario, and I'll talk about that in a couple minutes, but bring up the idea of being able to deduct the premium. And even with some of those really great features like 10-pay, return a premium, you can still deduct it because it's a long-term care chassis. Or if they say, you know, hey, me and my business partner, or we've got a small group of executives, we want to make sure that those people get it. We can make it voluntary for everybody else. With long-term care insurance, you can pick and choose. You can discriminate any way you want to. You could say anyone in the company who has red hair, we want to buy a plan for them. That's perfectly fine. Okay, you're not subject to any kind of discrimination rules with long-term care carve-outs. So selectively choose who the key employees are. Design a great executive style benefit for these folks with the executive style features on our product. So I wanted to also point out our tax summary, because it is a very useful tool, especially if you're not too familiar with some of the ins and outs of what to do when. There's different sections of this thing that will tell you what an individual can do, how it works for C Corps, and then self-employed folks, how it would work for sole proprietors, partners, S Corps, LLCs that are filed like an S Corp, etc. Your nutshell overview, C Corp is the golden goose. The C Corp pays for anything, they can deduct it. All the other self-employed types of taxpayers, generally how it's going to work is if they buy it on an employee or an employee spouse, it is deductible. If they buy it on, if it's an owner, or an owner spouse, it would be deductible by the business, pass-through income to the owner or the owner's spouse, and then that person could then, on line 29, use the self-employed health insurance deduction up to the age-based limits the IRS calls eligible long-term care premiums. And this is all in this document, very concise. This isn't, there are some carriers that put out these tax Bibles. Our tax summary is 4 pages, lots of white space, easy to read. So this is a great resource for you to have, and I know the folks at AIM, GoldenCare, and Premier would be happy to help you with it. So I generally like to talk on these things for about 20 or 30 minutes. I've got 24 past the hour, and I just wanted to do a quick recap of where this thing is going to fit well. And in my opinion, it's with small businesses, carve-outs, closely held businesses where the owner's interested in a plan for himself, his partner, or spouse. We could have a great solution for you. Because we have low minimum group size, we'll look at anyone with at least 5 employees. You don't have to send us a census unless you expect more than 10 to participate. Individually underwritten, so you don't have to worry about us having different premiums or a different product or a different benefit options. It's all the same as what you sell on the individual market. We issue policies between ages 40 and 79. We do go by nearest age. We do have eligibility for family members, spouses, of course, parents, grandparents, children, and siblings, and those of the spouse as well. Okay, so parent in-laws, grandparent in-laws, etc. Minimum participation is low, varying by state between 2 and 5 issued employees. And we do offer a list bill as long as there's 3 policies actively on the list bill. And there is no compensation reduction for using the employer group rate class. So I think as you look at the summary page, you can see the key points here. It's a pretty easy program to use. There's not a lot of different things about it from what's on the individual market. We're going to approve your group same day or next day. Participation's low, and we're pretty easy to work with in the worksite. So to kind of tie back to what I was saying in the beginning, we've got this traditional product. You can make it what you want to be, or what you want it to be, or what your client wants it to be, via some of these flexible features we went through, a joint policy with a 3rd pool shared benefit that you can, say, use a single premium, pay up on day 1, and you have guaranteed premium long-term care insurance. Say you added the limited return of premium. If they never need care, they both pass away, every penny they paid goes back to their beneficiary when they die. Pretty interesting conversations you can have in the worksite using either something that looks and feels like a traditional product, something that looks and feels like an asset-based product, all different designs you can do with this one product called EssentialLTC. And I think that also helps shorten your sales cycle, because you can take one arrow out of your quiver. You tell them about the company history, the product, they like it. Well, you can choose benefits, make it feel traditional. Check another box, you've made it feel like an asset-based product, all on this same traditional chassis. So I think that provides a lot of value to the conversations you folks can have out there in the field. And it is always my pleasure to help, but I know that Katie and Tom and everyone at these companies does a phenomenal job for you. All their information's here on the screen. And Tom, I don't know if there's any questions in the panel, but I'm happy to stay on and answer any questions. And want to just really take a second and thank everyone for your time this afternoon. I'm sure there's children or dogs barking, children running around in the background, all in our new normal. But I appreciate you taking a minute here and learning a little bit about EssentialLTC and what we can do for you in the worksite.
Thank you so much, Lawrence. Did a great job. I love hearing about different products and different ways that it can help people, because as you know, some of you on the phone know I'm very passionate about long-term care. It's never been more important than it is today. So anybody, when you can latch on to people like Katie and Mike over at AIM and his group and Katie's group and our people here at GoldenCare, it's important because it does end up, the buck stops with you folks on the phone, you agents who need to go out there and spread the word. So thanks for what you do as well. And we do have a couple questions, and I know Lawrence is a stud, so he won't mind if I bring up just a couple of them. I was lazy and I didn't read a lot of these beforehand, but if you don't mind, I'm not going to turn on the phones because of the background noise. We got a pretty big group today, but somebody typed in, what happens on the 10-pay premium if a spouse dies? Does the premium continue at the rate for both, Lawrence? And what if you put on the waiver premium if one dies early? Can you address that for me, please?
Yeah, so waiver of premium has nothing to do with when somebody dies. Waiver of premium would then go in when someone is on claim. Okay, so let's say you have, for example, a joint policy, 3-year benefit period, and shared benefit amount. Okay, so you got 3 3-year pools. Say one of them goes on claims for 4 years. So they've used their own 3-year pool and one of the 3 years in the shared benefit amount. That person passes away. The premium then comes back because no one's on claim. The premium does not get reduced when one of them dies because it's a joint policy that's issued. Okay, it was a joint premium. Actually, the way we initially filed it, there would be a reduction, but the regulators wouldn't let us do it. But how it sits today, yes, that premium comes back. Yes, it doesn't get reduced. The surviving spouse still has 4 years worth of care there. So to get a comparable amount, over all those premium paying years, if they got a comparable amount elsewhere, they'd be paying more over those years anyway. So it kind of levels itself out. But the bigger picture is, let's say you had, husband-wife situation. Who usually goes on claim first? The husband. So say the husband goes on claim at age 80 and claims for those 4 years. And let's say the wife was 78. Well, now he's done with his claim. She's 82. She's been helping administer his care for the last 4 years, and she's now 82 years old. How long is that premium going to come back before she needs care herself? Probably a couple of years. So when it really plays out in a real-world scenario, it all levels itself out pretty well. But that's how it works. Now, I know the first part of the question was about a 10-pay. And, Tom, if you could reread that part, I think I got too tied up in the second half.
Okay, no problem. I got to find it again here. What happens on the 10-pay premium if a spouse dies? Does the premium continue at the rate for both?
Got it. So unless that spouse dies within the first 10 years, the premium would continue at the same issued joint premium rate because we can't just change it according to the regulators and the way this thing was filed. So chances of the person dying in the first 10 years, probably slim, but by the 10th year, they're paid up anyway. So there is no additional premium due after that 10th year.
Perfect. Perfect. Thanks. Another question somebody had is on groups, can someone opt in for a 10-pay? Can certain people choose a 10-pay and others not?
Yeah, so that's another interesting piece of, no underwriting concessions, and we don't have all these, crazy restrictive guidelines with worksite. You can sell a totally different plan to every single person in the group. We're perfectly fine with it. So half of them could be 10-pay, half of them could be life pay, the owner could be a single pay. Doesn't make a difference to us.
Perfect. Perfect. I think this one's a little, I may email you this one. It was a little more detailed. I've got a few of them down here that I'm trying to answer myself quickly.
Well, that's a good thing. That means we got everybody syncing. So I'll look forward to the email.
Exactly. Exactly. Yeah. I'm trying to quick go. Would this work for a farm family? Example, parents and children operate farm, but none of them are actual employees. Okay. I know the answer to that, but I'll let you address it.
Yeah. So if they were employees, of course, they'd count as employees. But if, say, the husband and wife owned the business and they did have at least 5 employees, we'll approve the group. Whatever the minimum is by state, you need between 2 and 5 issued employees. But if you go back, I can go back a slide here. You see eligible family members, spouse, parents, grandparents, children, and siblings. So children could be eligible, but remember our issue ages as well, 40 to 79. So I find it probably unlikely that that child is age 40, and it depends. But yes, if the child was within our issue ages, they could be eligible as a child, even though the child is not an employee of the farm. But in farm families,
very good.
probably employed at the farm.
Right. Thank you. If you don't mind, I appreciate it. If you don't mind going on here, I'm trying to get them, so I'm reading some of these off the cuff. What happens when an employee leaves as far as portability? Do you want to address that? And I'll look for another one that...
Individual long-term care insurance. It is fully portable. They take it with them. There's no group policy, certificates of coverage. These are issued to each individual insured or joint insureds, if that's the case.
Okay, and somebody asked about Minnesota specifically, minimum size. Is there a minimum size in Minnesota for a closely held company? I would assume it's the 5, but...
Well, I'll tell you what I'll do here is I will go to our website. So if you go to our website, NGL-EssentialLTC.com, click on this agent information button and click on updates. This updates page has some great tools, one of which is our state variation listing right here. And it will tell you if the employer group rate class is available in that state. It's available everywhere but 3 jurisdictions, Arizona, DC, and Florida. And you can just scroll down here. So Minnesota is a 2 minimum, 2 issued employee here.
Oh, very good. Very good, thank you. Software, since you're on the site, you don't have to show them, but they wondered about software availability for rating in real time.
Yeah, so I know GoldenCare has StrataCision available for you guys. We are on StrataCision. If you want to show the employer group rate class, just select employer group under the rate class listings. If you want to use our program, you can go ahead and get a login to our website, and it's in the website there.
Perfect. This is you know what, I think this agent asked several really good detailed questions. I'm going to send them separately on there. Sorry, just for times.
Yeah,
how severe?
No problem.
You want to hit on this one? This is a little bit more broad, but I'm reading these as I go, so I'm sorry if I catch you sideways here. But how severe is the underwriting? Does each employee complete a paper application with a lot of yes or no to different medical questions? What's the question there?
Yeah, so same app as the individual market. The only different thing you're going to do is put a group number on it and select employer group for the rate class. Beyond that, it's the same app. So you could do it by e-app, you could do paper app. It's entirely up to how you prefer to, submit the business. But we do have electronic application available. And what was the other part? Oh, how severe is the underwriting? I think we're pretty well in line with what else the other carriers you're used to out there. Everyone's pretty well underwriting things the same for the most part. Each carrier has their little, quote, sweet spots, I know agents like to call them, in their underwriting, but I think we're pretty well in line with what you're used to writing.
Okay. Well, and you know what, everybody, great questions. Tell you, I'm really impressed. I know that you guys started typing madly once I started because I thought I was going to get by with a few questions, and they're typing out a lot of them. So I think what we're going to do, if you don't mind, is I'm going to go ahead and I'll have these questions available, and I'll get them over to Lawrence or Katie or myself, and somebody's going to get an answer to you, if that's fair. And we'll make sure we get that out to you, and maybe we'll even put together an FAQ if it's not too much work, if that's okay.
Yeah, that'd be great. And Tom, can I get one more point in real quick about underwriting, because I know this is on people's minds right now. With regard to COVID, we are still accepting applications up through age nearest 79. We're not going to send business back to you. We're not going to tell you we don't want it. We want your business. We appreciate it. We just ask that if it is a lockdown area, you either understand that it's going to take a little longer for us to process the app than usual, that the insured's going to have to let a nurse into the house if it's age 66 to 79 to do a face-to-face interview. And if it's a lockdown area where by law we can't do one, we'll keep the app open as long as we possibly can to get that face-to-face interview done. So, and in terms of underwriting, I think we only had one decline because somebody did test positive for COVID-19. Beyond that, that's the only real new underwriting guideline we have. If you have a positive test, we want at least a 6-month wait. If you've had symptoms and haven't been tested, we want at least a 3-month wait just to assess whether there's any residual lung damage. So that's really the only underwriting change. Beyond that, any age you've got up to age 79, between 40 and 79 that is. We appreciate your business. We want it, and send it on over. Just understand it might take us a little longer to get done what we need to get done.
Perfect. Yep. Thank you very much. I appreciate everybody getting on, Lawrence, especially you taking your valuable time to jump in here. I know you're working at home and you've got the little guys hanging outside your door waiting to pound in and come and keep you busy the rest of the afternoon. But thank you so much for coming. Really appreciate it. I'll get these questions over to you as well. And I really want to end with just a call to action to you folks on the phone again. There's seniors. We all know the stats. 10,000 of them turning age 70 every day now with the baby boomers, and we know these are trying times and weird times that we live in, that a lot of people are going to scratch their head as this comes to a fruition, if you will, and they're going to need solutions, and they're going to be looking for professionals and specialists like you to help them out. So I really urge you, reach out to our friends at AIM. Again, Mike, I'm sure apologized that he couldn't be on, but reach out to our team at GoldenCare and Katie's team at Premier, and Lawrence and his team, because we're all in this together. We want to go out and help as many people as possible in America. We've got a lot of gray hair in America, and we got a lot of people. There's no other good solutions out there. So I really urge you to take the time to go out and embrace these products and find all the different solutions that are available for you and your clients. So, Katie, I would love to have you jump on and say goodbye, or any final words you have before we close it up.
Well, your message there, Tom. I think that Lawrence, as always, you did a fantastic job. And please reach out if there's anything any of us can do for you, whether it's sales ideas or quotes or just generalized long-term care questions that you may have. I mean, I would welcome any of those phone calls, and all three of us, AIM, GoldenCare, and Premier, are here to help any way we can. So that being said, I appreciate everybody taking the time to join us.
Okay, thanks, Katie. Appreciate it. Thanks, everybody. Again, Lawrence, you're a stud. Appreciate all you do, and we'll keep it open for you, and we're here as always to help you, like we said. So this is Tom Randall from GoldenCare saying have a great afternoon, stay safe, and hopefully we'll have a chance to work together soon. Take care, everybody. Thanks again, Lawrence. Bye-bye.